Heavy is the head that has to manage all of this.
Hey everyone, welcome back to my channel.
We're now incentivized to buy what we already buy.
Fumbling through college had me building.
I also got some done on the other side.
And that was right around, I would say, May, maybe right before renewing the lease for this property.
Welcome to the channel, Martha.
Thank you for having me here.
Oh, I was going to say, I am getting up in their names, I'll tell you what.
Bills paid by other people, life was never this good. I had to step back, knowing that it's...
Hey everyone, welcome back to the channel. So today we're going to talk about why mortgage rates are still high. And we're going to talk a lot about what you should be doing in 2025 to prepare for the housing market and everything that comes with it. So, as you all know by now, I used to be a home lender for Chase, a mortgage lender, right? So I did a lot of refinances, and I was actually on the refinancing side of things. And so refinancing, they had a little bit of a tougher requirement. Actually, it might be a little bit more lax than home buying because you already have the property, which has some sort of equity. And so we're not necessarily harping on the fact that you need to have the best credit to do whatever it is you're doing. But typically, for our borrowers, at least at Chase, and every other lender is going to be different. At the time, you needed a 680 credit score to do a proper refinance and have access to most of your refinancing options. A 680 credit score is basically the floor. That was the bare minimum. Now, it took me a while to actually get accustomed to what different people needed because I've always had good credit. And so I've always hovered around 740 to 800. And, at Chase, at the time of when I was there, they capped at 780. So if you had a 786 credit score, it didn't matter. A lot of people chase that 850 credit score, but it doesn't help you get a house more than the person with the 780 credit score, right? And so all that 850, 800, it really doesn't matter. Do you have a 780 or do you not, right? That's the max credit that they'll take. That means you are A-OK, you are the best of the best, and you can get whatever you want at a 780 credit score. Now, what I was telling people is that you don't necessarily need the best credit score before you go out there and buy a home. And the reason for that is if you had a 680 credit score back in 2022 when interest rates were 3%, you might have paid 3.7% for your mortgage. But now, even if you have an 850 credit score in 2024 or early 2025 where we're in right now, guess what? You're still going to be paying high sixes. So you're going to be paying way more than the person with low credit that paid in 2022, right? And so everyone is fixated on, let me get the best credit that I can so I can get the best rate. But really, you're just getting the best rate for the time that you're in. And with mortgage rates coming down, it might even be a great time for people to start working on getting their credit up to where they can afford to get into a home. Now, I hate the word afford, so I'm even mad at myself for using it because afford means that I cannot buy said thing, and so I can do this at the expense of something else, right? And at the time when I bought my first two properties, I could only afford those two properties. What do I mean by that? I put 10% down on both of my properties and it wiped me out both times. Now that is a high risk, high reward concept. The risk was I didn't have money for any repairs, any damages, or if anything were to happen, right? But the reward was if I was able to stack money without any major damages occurring during my time of stacking that money, then I would have the lowest mortgage payment possible at the time that I was able to purchase the home. Why? Because I put all my money into the down payment, and so that in turn gave me the lowest the lowest mortgage payment that I could possibly afford, which made it a lot easier to rent out the properties, and it also made it a lot easier to make those payments every single month as well. And so the long-term benefits of that was very, very good. And I just so happened to not see the risk or not experience the risk at that time. But when you put your hands in the cookie jar enough times, you'll start to gain some weight or get diabetes. So I did that twice. I always tell myself in the back of my head, if I did that 10 times, at some point I would be bitten, right? At some point it's going to bite me. It's just a ratio, right? And so I was successful twice, putting all my eggs in one basket, twice putting all that risk. And of course, did it help? Absolutely. I'm in a way better position now because I maximized what I was able to do. And because I maximized what I was able to do, I was able to save more money. I was able to take in more money. I was able to spend less on the mortgage overall. And I was able to get my PMI taken care of a lot quicker as well. And so a lot of benefits of taking those risks. But I would not advise people to throw all their eggs in one basket. If you have 10% for a down payment, I'd say at least have enough for your, what is it called with your insurance? Your, is it deposit, premium? What is it that you have to pay before they start to pay out? You know what I'm talking about. Let me know in the comment section down below. What is it that you have to pay before your insurance pays out on a claim? I can't believe I'm forgetting the name of it. But yeah, let me know what that is in the comment section down below. So for example, if your house were to catch on fire tomorrow, you should have that thing that you need to pay out before your insurance will pay on the claim itself. All right. And so, yeah, that was a high risk, high reward thing that I did twice. It paid off twice. But again, if I had did that 10 times over, I would eventually get burned at some point. I already did it twice. So 8 more times, I'm definitely going to get burned on one of those. And I would not advise doing that. So basically, I say all that to say, get your credit score to a decent number, 700, 720. At 740, you're in a better tier. I believe that's like average, if I'm not mistaken. Let me see, what is the average credit score today? Let me just take a quick look. The average credit score is a 717. Right? And so, I see people post on Facebook all the time, hey, I got my credit score to 700, or I got my credit score to 720, or I got my credit score to 680. Those are all good wins. That means you're being more responsible with money. That means you are dedicating and focusing on bettering yourselves in ways where you're responsible, where you're paying off debt, where you're paying off things that you paid for. You're having integrity about yourself. You're showing that, you're showing your character. You're showing, listen, I may mess up, but it's only temporary. I'm here to make changes within my life. It tells me more about who you are as a person, and it definitely lets the banks know, hey, this person is a great borrower of our money, is a great consumer of debt, right? And there's 2 ways to consume debt and be great at it. You can consume debt and never pay it back. You're still a great consumer of debt. Or you can consume debt but also pay it off. And that's a great consumer of debt in my estimation, where you're gaining the rewards of the cash back, the points, and all that stuff, but you're also paying it off every single day, and not letting that stuff accrue additional interest on your accounts. right? So 717 being the average credit score, the average person in October of 2023 could essentially afford a home, right? Or could purchase a mortgage. And so with a 717 credit score is really not that bad, right? And again, it's saying that the average credit score varies by age. And this was a poll taken out in October of 2023. It's saying that anyone from 18 to 29 had a credit score of 680, which is barely being able to refinance at Chase at the very least. Now, other lenders might let you refinance at a 620, but Chase Bank probably wouldn't let you do that. Then you got your 30 to 39-year-olds who are at 692. All right, so 692, slightly above the 18 and 29-year-olds. Then you got your 40 to 49-year-olds who are at a 706. Then you got your 50 to 59-year-olds who are at a 724. All right, and then the silent generation, I didn't know there was a such term, but anyone 78 years of age and older are at a 761. All right. These are all assumptions now, but as people grow up in age, obviously they have more responsibilities, children, housing, food, all the stuff that you can no longer pass on to your parents or significant other or family members, right? You have to start taking care of yourself. With that responsibility comes some integrity about yourself. And so you're starting to pay off things that you once did not pay off. And then also, credit cards come with different factors for how you can raise your credit score. And so one of those are to have time, the oldest length of time on your credit, right? So an 18-year-old is not going to have any credit history, and therefore their credit score can't be a 709 or sorry, a 761 automatically, right? You have to work on your credit. You just have to let it build over time so that you can have a better credit score. I believe that it took me maybe 3 years, 4 years before I was consistently seeing 730, 740 on my credit score. Now, I wasn't necessarily looking at my credit score when I was 18 and 19, so I can't tell you what that was. But by the time I was 20, definitely 730, 740 was the norm for me. And I didn't necessarily use my credit card for much. I used it to pay my phone bill, and I just used it to buy clothes here and there. I would always splurge on $2,000 worth of clothes every year for about 3 to 4 years. It was almost a tradition for me because I would buy nothing all year, and I would say, man, after saving $10,000 or investing $10,000, let me spend $2,000 on me. And so that was my way of treating myself for the first 3 or 4 years when I started working. But to cut a long story short, we're still talking about mortgage rates and why they're so high. So the Fed is cutting rates. That is just one factor in the economy for why rates would go down. Now, the Fed cutting rates does help because it does give the banks more room to lower the interest rates. Now, there's a lot of reasons why the bank wouldn't want to lower interest rates. Investors don't want to be buying investments that are only giving them 4% returns or 3% returns. So a 6% or 7% return on a house as their collateral is much more advantageous than a 2, 3, or 4% return. Another thing is that these banks can now borrow from the Fed or other banks at a much cheaper rate because the Fed has lowered their Fed funds rate. Banks are able to borrow more cheaply, and so that's also going to drop the high yield savings account and certificates of deposits down, because why would the bank pay me 4.5% on my money when they can borrow it from the Fed for 4.2%? Of course, they're gonna have to lower the certificate of deposit, because they're not going to be really making more money than they would buying from the Fed. So the banks are always going to give us a lesser return than what they would get from the federal government. So always keep that in mind as well, even if it's ever so slightly. Now, another reason why the bank's rate is going to stay high is because of treasury yields. So when I was working at Chase Bank, they never actually talked about the Fed funds rate. They always talked about treasury yields and how their mortgage numbers are backed by the treasury yield. So if the treasury yield is high, mortgage rates will be high. If the treasury yield is low, mortgage rates will be low. And I didn't understand it at the time. But when the Fed started raising rates, guess what? The mortgage rates followed. But it was because treasury yields were also going to rise due to the fact that there was less faith in the U.S. economy. And because of that, with treasury yields rising and things being unprecedented, and you're unable to predict what is going to happen in the markets, the banks had to then raise their bank rates and their mortgage rates. So that makes it so much harder for people to go out there and buy a home when interest rates are more than double what it was just 3 years ago. Now that we're in 2025. And so I say all that to say, get your credit right. Understand that I do believe that rates will go down a bit. I see it being in the low sixes by the end of this year, but I just cannot see right now it getting into the mid fives. I would absolutely love for it to get into the mid fives, but I just do not see that right now. So if you like this video, make sure you leave a like, comment, and subscribe to the channel. You know I post on YouTube, Rumble, and Spotify for podcasters, and I can't wait to see you in the next one. Peace.